The Reserve Bank of Australia has cut rates by 25 basis points today to 3.85%. What's been really interesting is that in the forecast changes and in the qualitative statements surrounding the decision, they are leaving the door open for another rate cut in the coming months. Now, why has the RBA cut? Well, what they basically said is that there's a lot of uncertainty in the world. And they think that that uncertainty will weigh directly on people's spending and borrowing decisions, even in the Australian economy. They're hopeful that China will stimulate to offset some of that. They're also hopeful that although America may be experiencing a bit more inflation as a result of tariffs, that we actually won't be getting that. So that's the net balance of factors. What's really interesting in their forecasts is that they've actually assumed an even lower cash rate by the year end and out to 2027 than what they had previously. Yet despite assuming a lower cash rate, they've net downgraded their growth and inflation forecasts. So what the RBA is saying is that they do expect a material slowing absent them acting, and this is the reason why we think they're effectively guiding the market to another rate cut. Now, how do we invest on the back of this? Well, we suspect that cutting now in response to the bad news, that can be a right response, but given that ever since Liberation Day, markets have actually rallied and sentiment has actually improved, there is a little bit of a risk in cutting too hard if not recognizing necessarily some of the positive developments that have happened since that time. What we can see is that short-term interest rates probably do have more to fall. And as they fall, how do we expect to position for this? Well, one thing here is that bank net interest margins are heavily tied to short-term interest rates. And as rates fall, you would expect a little bit of pressure on bank net interest margins, which is a marginal negative. If you believe that the RBA is cutting because, in fact, there is more downside to the economy than previously thought, well, that's not necessarily going to be a great signal for cyclicals, unless you believe that actually the RBA's forecasts aren't quite right there. If you think that the RBA is going to not cut as aggressively, then obviously you'd be in insurance. But right now, we like real estate investment trusts and infrastructure names. We think that they can outperform simply because rates have fallen.